The views expressed in this video presentation are my opinions and not necessarily the opinions of guests and others sharing or reposting this video. The content is produced only for educational and informational purposes. Do not regard any statements in this video as a recommendation to buy or sell any financial instrument. Investing comes with risk to loss of principal. Always conduct your own research and seek guidance from a professional investment advisor. I am not a professional investment advisor. I'm Dollar Will. It's together here. Got nobody in the chat, but I'm gonna go ahead because life goes on. I'm gonna post this information. I'm gonna get on back to my trading. Let's see. This screen share happening. Let's see. Everyone should know that I am a practitioner of technical analysis. I emphasize technical analysis over fundamental analysis. You can learn both, you can practice both, as long as you remember that technical analysis is superior to fundamental analysis. If you are buying just industries as opposed to individual stocks, technical analysis alone can work for you. Fundamental analysis can help you differentiate the best stock among its peers, or best what is best, safest to your comfort level, because all of this is about managing risk, and it's things like whether the company has a track record of success, success being defined as making money, earnings growth, that type of thing. If that makes you sleep better, if that's the way you pick your stocks, then fundamental analysis can help you differentiate one stock from another within a country, within an industry, and across the industry. If you just want to know that, hey, there's a real business underneath the stock symbol and price jumping around on the chart. And because there's a real business and with real profit, I trust this company will be around a while. That's where fundamental analysis comes into place. Me, I have a top-down approach, I guess you would that way. At the top of the apex, there's sectors. Stocks are grouped into sectors, and then those sectors get parceled out into industries, and then you get the individual stocks. So I buy sectors and industries. I generally don't buy individual stocks. That's just a personal choice because I don't like the fate of my investment or trade, and you'll hear me use those words interchangeable. It's the same thing. Don't fool yourself. Every investment is a trade. Everything you buy, you hope to sell it at some point in the future for a profit. It's a trade. Whether you held it for 5 minutes or 5 years, it's still a trade. Don't fall into that trap of calling bad trades investments. Okay, don't free yourself of that right now. What was I saying? Oh, so I buy whole industries or whole sectors because I don't want to be tied to the performance of the CEO or the CFO, or if they stealing money, or if there's a class action lawsuit against them, or anything that's company specific. I don't like being associated with that. I don't want that level of risk. And now that we have leveraged ETFs and things like that, as a trader, I can find a setup. And then also with technical analysis, everything that basically, if I had to say broadly what the difference is, fundamental analysis is a lot of stuff that, say, accountants would deal with. The book, the I guess that's it, accountants, the monthly report and the earnings statement and the debt to income ratios, things like that that an accountant would deal with. Technical analysis is rating, more specifically, the popularity of the stock itself. That's a gross simplification of it. And there are all kinds of theories about how far a price moves before it has to have a pullback. Sometimes it's called air quotes correction. And depending on what school of thought you're in technical analysis, there are certain rules about that. So that's in short about what's that about. Now, today you see this definition on the screen. That's the word of the day. Myopic. Because there's games being played, against you in these markets. Myopic. Let's look at it. What is it? I'm not talking about myopia, or is that the way you say it, as it relates to vision acuity with it having to do with your eyesight, literally the function of your eyes. I don't mean it literally myopic in that sense. I mean, like if I say nearsighted, that's one adjective. I mean, if we're talking nearsightedness in terms of the way you think, that's not necessarily the way you see, or short-sighted in the way that you think, or we think, or the way that we are conditioned to think. It's blind as a bat. Wow, okay, yeah, that fits too. Unimaginative, okay. Yeah, that can go with it. Uncreative, adventurous, narrow-minded. So the ones that I want to focus on is narrow-minded, nearsighted, short-sighted, and these markets, or the news cycle, creates a myopic way of thinking. This is coming from a technical standpoint. When you get too far into fundamental analysis, you can end up with a myopic perspective. a nearsighted, short-sighted, blind as a bat perspective. I know I'm triggering people who were raised on fundamental analysis. But the deeper you get into this trading world, you'll learn how many people are just straight up lying. They are technical traders posing as fundamental investors because they don't want the smoke. Because fundamental analysis is what's usually taught. And when people really start making money, they kind of defect from that. I've put on here somewhere on the channel, next time I'll have it handy, where people like to tone out Warren Buffett and his success and use him as the patron saint of fundamental investing. And I showed in a video how this quote unquote coincidentally he happened to sell stock when nothing changed about the data, about the performance of the company. But it did. He happened to sell right at a technical level where all the technical folks were getting out. So yeah, it's like you don't know what you don't know until you give this technical analysis a shot to really learn and see what's going on. A lot of your questions will be answered about why did that stock go down? What made it do that? So myopic has extended meanings too. Someone myopic might have trouble seeing things from a different perspective and considering the future consequences before acting. Well, I guess that kind of works too. But more to the point, Exxon had a $4.7 billion second quarter profit as demand was claimed for fuel rebounds. Well, if you're looking at short-term news or near-term news, you can lose track of the broader picture. I would say a good example of myopic would be if you put your nose in the palm of your hand. You can't really, it's hard to really see all your fingers. You really tell how many fingers you have till you move your nose to further away from the palm of your hand. Now you can see. You can see the thumb, the fingers, and all of it. You can see it at the hand. Well, technical analysis saves you from that because, again, depending on what school of thought you're in, I'm in the Elliott Wave theory school of thought, and typically we look at big data sets. It can go back 100 years. Because especially when we talk about a commodity, there's a demand cycle. Everything goes in demand, people buy it up, and we're talking it can rise over generations. You have to go back to your grandfather to see these cycles. You're not going to see it in your lifetime. So that's the first big hurdle. It's people moving from fundamental analysis to technical analysis. They have to contend with that reality. So you won't find me arguing about what the president, their impact on the economy and things like that. The presidents join a cycle already in progress, and they just have to manage that demand cycle. They're not in control of anything. Okay, so they just have to not mess it up. So this is happy days. ExxonMobil swung back to a second quarter profit, top expectations as demand for fuel recovered. Well, demand relative to when, we still have a glut in oil. There's not been there's no demand over the long term, and you can see it in the price chart. So you know common sense, when something is in demand, the price rises. When it's not in demand, it falls. It falls. So what we're looking at here is a monthly chart of Exxon. And this high here is from 2014. And that's now, if someone told you, and this low here is this is March of 2020, like the rest of them, everything else. And most things bottom around March, and we've been in a run up since then. Okay. Now, if you were looking at this picture, I'm going from 2014 to March 8th. This would be March, and this would be October. Okay. So if someone told you in 2014, and you're looking at this picture of the price of Exxon stock, I could pull up oil futures. It's gonna show a very similar picture. But if you were looking at a picture like this, if someone said to you, oil is in demand, you would know your BS detector would go off. The news will tell you one thing, but price don't lie. And we in the technical camp, we don't believe people. We know people lie, including CEOs of companies. They lie during earnings reports, so we don't trust in what they say in the books. So that's one major difference between technical analysis and fundamental analysis. On the technical side, we know people lie. We place that secondary, if you consider it at all, because the foundational principle of technical analysis is everything there is worth knowing about a stock is already baked into the price. The smartest, richest people in the world are buying and selling this thing, and you or I will never know what they know. We don't know exactly why they're buying or selling. And in technical analysis, we don't care why they're buying or selling. It's enough for us to know that they're buying or selling. That's it. And as long as whatever they're doing, whatever they, the big they, whatever they are doing, we want it. So if they're selling, we want to sell. Because you're not going to, the news lags the truth. So there's something going on, and then later on it comes out in the news. You will never have news at the moment of, say, the price is doing something. News is going to lag, and then that might not even be true. So we just free ourselves of all of that in technical analysis, and we just watch what people do. We watch the money. We watch how, and this is money. Watch how the money flows. Watch, and this is also sentiment. The innocence. What am I struggling with conceptually here? There's a thing called volume. It has to be factored in. It's like an auction. You go to an auction in the beginning, you got a lot, and the stock market is an auction. Okay? It's like you go to an auction, there are a lot of people bidding on this thing in the beginning. That's big volume. Over time, people fall out of the bidding process as the item increases. You're watching the market value in real time. So the price gets bidded up and the masses start to fall back. They're out of the bidding process. And a smaller number of people keep bidding it up, and they determine what the market value is. Isn't that funny? A small number of people can say what the market value is. The person that most recently sold a home in your neighborhood, they determine the market value, not you. It's the recent. I'm trying not to say idiots. It's the greater fool theory in stock. You buy something and you're hoping that a greater fool than you comes along and pay a higher price. And at the end of the game, sometimes you discover you're the greatest fool. You buy here, nobody wanted to buy it higher. You're the greater fool, or the greatest fool. You're the greatest fool. But anyway, so when Exxon says demand, so they're just looking at this little return. Well, my technical argument is that this trend that started in 2014 is not over. Okay, we just had a reversion to the mean, a nice little pullback to this area of interest before the floor fell out. So you can look at these price lows here and say at one point in time, everything looked good. Like, okay, we got a price floor. Okay, like we're gonna go up from here. Well, that didn't happen. And so all that happened was the price traded back up to this area of interest where there were a lot of people interested in this highlighted area, giving these people who lost money when it fell, they get a chance to sell to get their money, their break-even point. So they're at the point of break-even and they're selling. So this article was posted. The earnings came out, what was that, for July 30th. So that would be this past Friday, a week ago. So let's see. And the earnings was good news. It was good news. That's very important to remember. This is good news. Profit, that's good news. So according to the way that fundamental traders think, the good news makes the price go up. Now, that's the myopic crowd. I know I'm triggering people now. I know you got a degree and I don't, but you're wrong. You're wrong anyway. And you paid for that ignorance. Yeah, I know. If you really love fundamental analysis, add technical analysis to it. Your fundamental analysis will be worth a whole lot more than you if you add technical analysis to it. Because you'll know when in time to ignore the fact that Exxon had great news. You'll know to ignore it, especially at this particular point, for technical reasons. And the technical reason here is the price is overboard. It had a good run. It's due a pullback. That the psychology of the market is that people are typically going to sell when they get a chance to break even from their loss. Okay. Now, whether I believe you want to go lower than this, I could be wrong, but I could be right. But if you had this profit, you would know, if you're coming from a technical perspective, that people are going to sell right here. You would know to take your gain. And then as the market, you would watch the depth of the decline to determine if it was safe to get back in. All technically driven, completely ignoring news and earnings report. You would watch the flow of real money, step in and save this thing and stop it from falling and make it start going up again. Then you go, okay, whew, I saved myself from this decline. And now it looks like it's rising again. Let me get back in. You know, all based on some technical factors. I'm not getting deep into those technical signals here, because that's what I do on Patreon. I got to get the value to them. You understand? I'm just trying to show you a point of view, the way that we technical traders view the markets, and try to find value, try to get in at these low points when it's about to rise. Okay? So I connected these lows right here. And prices have a tendency to trade in a channel. And I just think, and there's a balance and kind of symmetry in the universe. It could get spooky. I don't want to get into the spookiness. But you see here, when I had that line here, that was a floor for the price. We call that support. And when I moved it up above here to show a channel, this close enough government level. So you got a diagonal channel going down. And you got the floor. So all I did was, because we know in technical analysis there are patterns that are traded, and the whole, just the gross simplification is that there's symmetry in this market. There's geometry in price action, price activity, because the price action or the movement of the price is determined by human beings. And human beings are creatures of habit. So we have a collective way of doing things. We're collective in our behavior. So there's market psychology. So it can get deep. So we're not individuals. We're really not. And so we're so much pack animals. We're so much pack animals that you can see the symmetry in the price charts. So that's a little bit of that. And this picture proves it. It's whether these patterns happen because we believe this to be so and we make it happen, or whether it happens because we really are just that rhythmic and group think in our behavior. You can pick whatever way you want to look at it, but I'll tell you this: way back before we had computers, we had chart data going back over 100 years, and we see these same patterns before anyone could be conscious of these patterns, because you didn't have computers, because computer wasn't invented yet. Okay, so we know that this is a fact, that people move, and there's a herd mentality that's baked into the DNA of being a human being. Okay, and it comes out in everything, including price charts. So just to get beyond that. Oh, okay. Wow, I got people here, man. Y'all got to kick this from the beginning because I had to start. Um, um, I'm gonna finish this. I need to see if I'm messing up anything. Like, hey, your mic is turned off. And, I'll do that. What's up, Wadden? Wadden keep calling me a millionaire. Dude, I ain't no millionaire, bro. I done paid a whole, when you make mistakes in trading, I call it the stupid tax. I pay a lot of tuition. I paid a lot of tuition to get to this level of awareness, okay? So I'll say it's people around me in my Patreon, they get paid because, I've had to, put myself in recovery or, from some of my stupid tax over here. I'm doing all right. I'm doing pretty good. But man, if I had somebody like me to just break this down and make it say, look, this is how it works. Forget what the 80-20 rule is real. Okay? And it's a lot of stupid stuff being taught, even at the university level. It really is. And you won't know until you get to the other side and the back ones. And the people that do know, they don't want the smoke. So they don't need it. They will pretend to be fundamental traders. But when you come to the technical side and you watch them change their sentiment, when no data, no fundamental data signals that they should have changed their opinion, you know that they are a technical trader just lying. Because in fundamental analysis, you're supposed to buy on the dip. If all the news is good, and all of the accounting, the statements and all that stuff look good, all the earnings looking good, sales pipeline still looking good, there's no reason to change course. You're investing for the long term. You're supposed to buy on the dip because the stock just got cheaper. Because that's the way you're supposed to think. If that's your religion, fundamental analysis. When I start seeing you do some different things that's against your religion, I go, you just lied. But you won't know that until you become a technical trader. Because it's just too hard to argue against the establishment. Let's see, I'm gonna speed this up. Let's see, I can't see the name, but OCA OSD1. What's your thoughts on the current stock market? We're negotiating. I have to only say this in terms of Elliott wave theory. That's what I think. This SP 500 is negotiating a top to a wave 3. The large wave 1, it was like mammoth size. So it's just through the scale of everything off, and these uptrends are taking longer than I say than we psychologically comfortable. So I'm looking for another maybe 5% up in the market, and the market moves typically about 1% a day. Next Friday, next Friday we could be there. Either next week or the week after, we could be close to this correction. But I'm not. The trend that started in March. I'm talking about a pullback. I'm not talking about the end of that. The trend that started in March, April 2020. Let me speak into complete sentence. I'm not calling for the end of that trend. In Elliott wave terms, we would call that wave 4. And after wave 4 comes wave 5, which goes even higher. But we're going to have a significant pullback, but it's not going to be the end of the trend. So I don't think that this whole trend is going to end. I think we're going to get into 2022. And the fear porn, when we finish the wave 4 correction, get into wave 5, and come back to, say, the general price area where we are right this second, you will hear, I will be posting fear porn. But my fear porn stopped when that uptrend from March of 2020, when it rose beyond a certain level and it looked like it was not pulling back, I had to accept that here it comes. I was wrong. We had at least one more leg higher, and that's where we are. So we might be March of 2022. So so we might get that 2-year stretch on that before this thing is all over. But just back to the oil for a second. If you think about in our industrialized economies around the world, you need oil to run those factories. So we uh, had a glut in oil that took multiple generations to create. So back to what I was saying earlier, technical trades, we don't get caught up in things like, this is what this president said or that. It doesn't matter because we're talking about multi-generational consumption patterns between countries. We're talking about rebuilding of nations coming out of World War. That cycle, okay, the cycle that took us through the baby boom, that required us to build more homes, more schools, more churches, more healthcare, more of everything that humans consume. So that's the cycle that we are, quote, correcting. Okay, so just know that when I'm talking, I'm talking like 100-year chart kind of stuff. It's been a big move since the end of the Great Depression. We're in that cycle. That's the scale of correction. So when people, a term you can look up is called grand super cycle. So the Elliott Wave parlance, that's the way we look at it. Consumption of resources over multiple generations. So it just takes a while for that to correct. So um, it's going to be this correction when it comes, when we get to that wave 5 and complete it. We're still in wave 3, negotiating a wave 4. So wave 4 is down and wave 5 is up. But wave 4 down is still part of a bigger trend that's still going up. So whenever we finish the whole 5 count, we're going to be back to talking about, we're going to be looking at those 2009 lows, somewhere in that area. It's going to be ugly. And just know that when we had the quote Great Depression correction, I think that took about 2 years or something. So it happens fast. So, but moving on, because I don't know if this video to get that long, but let's see. So that's Exxon. There is an inverse relationship between the U.S. dollar and energy and metals. So it means when the dollar goes up, let me look at gold first. When the dollar goes up, generally speaking, oil and metals go down, and the converse. So let me see. I don't see it on here. There was this chart I can go back from. Oh yeah, it does. Thank you. Y'all find me on these YouTube streets picking fights. Picking fights when I hear people with that barbershop talk saying, gold is always safe and a house is always safe. None of that is true. There's nothing that's always safe. Only knowledge is always safe. Okay? So I'm not getting in deep into this because, of course, that's for the Patreon folks. But this is a picture of gold. So this goes all the way back to the area where we came off the gold standard and all that stuff. And so that's what. So when I pull up the dollar chart, you're going to see the inverse. Okay, you're going to see how that. I don't know how this compare. This. A lot of times it don't show up right. See, yeah, because yeah, it's not gonna show. Right. Let me try. Let me hide that. Okay, right. So whereas gold was rising since 1971, the dollar has been falling in that same period, making the point that there's it's like a seesaw. When one is up, one the other is down. So typically, the dollar is like made to decline, pretty much, because value transfers from the dollar to the commodities, things that you, man, I say all things that you got with the dollar, but your house is like a bunch of commodities. You got a lot of metals. It took energy to make the metals. Um, you got aluminum. You got conduit, which is copper. You got steel frame. So you got metals for your all types of composite metals to make your appliances. You got wood. So when you're buying a house, you're buying a lot of commodities, and those commodities have an inverse relationship to the dollar. So this is the value of your paycheck. This is the spending power of your paycheck over time. It goes in the toilet unless you do something with it, like trade these dollars for something that rises, like gold or a house and that kind of thing. So typically, over a long stretch of time, yes, you do make money investing in gold and buying a house. Yeah, in general. However, you get caught in one of these moves. This is 1973 to 1985. That's a 12-year period of the exception to the rule of the dollar rising and oil and gold and all the in your house and all this the smart things going down in value. It's not exact. It doesn't move exactly on the day, but over time you do see like housing and those other things reflecting to the fact that the dollar is getting stronger. So you see that. So that tends to have a negative weight on other things that are negatively correlated with the dollar, like your oil and metals. Let me see. I want to show this. Okay, and I gotta go. I have a chart, a video which says gold ain't ish. I put that on there just to trigger you folks to make y'all watch it. But it's going back hundreds of years of data about gold to show how dangerous that idea is that gold is always safe. This peak here is 19. Wow, that's a shot. Oh man, oh man. It's somewhere around 82. I know this says 80 on screen because I'm using a line chart, but on the candlestick chart, somewhere around 1982, I was a senior in high school. Run DMC was really just coming on the scene. That's when you start seeing the Dookie gold chains, big fat gold chains. So rap music picked up on that because gold had hit at that time an all-time high. And so it's become like a staple in rap culture. And it had to do with what was going on in the macroeconomics at the time in the culture. And so then we started buying gold because that's the way it goes. The people that are the poorest hop on to the thing at the end. And so we hop on it. And I'm even going even more sinister. The richest people in the world, they know that we think like that. And that's when those commercials come on TV telling you that you should buy gold. And I remember them coming on TV right at this time. These are the richest, powerful people in the world talking to the least educated and the poorest people in the world to get them to do the dumbest shit at the exact wrong time. The matrix is real. Okay? Okay? And you even find people with college degrees telling you this shit. Hey, it takes a while to crawl up out of it. You start learning the truth, you become a weirdo. You become a weirdo to most of the world. You can't They won't know what you're talking about. But anyway, gold fell from 1982, didn't really, and it hit this bottom around 2001. So we're talking, let's just shorthand it and say that gold fell for 20 years. So if you were born in year 2000, your frame of reference, so that would make you about 21 years old. So you would think that gold always goes up because in your lifetime, it pretty much did. So back to the myopic, that was the word of the day, myopic. So if you have been around a little longer, you remember when it was in fashion and out of fashion. Okay, when the tech bubble burst, the dot-com bubble burst around 2000, Prince singing 1999, money rotated from those semiconductors to healthcare and gold. That's what mostly won. Okay? So this picture makes the point. This 20-year decline that gold is not always safe. There is some debate about if this is a completed pattern and we're going down. We'll see. We'll see. I'm in the camp that it is complete. We are going down. And we're going to take out this one. That can be to get right to the point. That we're going to see a massive devastation in gold. My view is not the predominant view, and I would say the chart doesn't necessarily validate that view until we go lower than the low from March of this year. Okay, and just to be completely honest about it. But due to some other things I can't really get into here, Elliott wave theory, wave counts, and all that stuff, I think this is the top. Okay. And I think that this is a mature 5-wave cycle from here. And in Elliott wave theory, after you get a 5-wave cycle, you get a correction. It typically between, it could be as shallow as 50%. It could be like half this value gone, half this run gone, or it could be up to 78%, you know. So that would be more significant. Okay. Pretty ugly. Okay. Yeah, giving back most of all of this. Going back to 2001 at the black. Okay. It could get that ugly. So, and I'm in that camp. And this is coming from looking at charts and stuff that go back to like year 1900, and again, to see a little bit of that perspective, watch the video on my channel called Gold Ain't Ish. And you know, that's back when I was picking fights when gold was rising and people saying, y'all need to buy gold, and I was making fun of the gold bar. You know, I'm only doing it for the shock value because I know I have to come out and say outlandish stuff to get in a fight, to get your emotions involved in it. And then I could get the information across. But I can't penetrate that idea that gold is always safe and housing is always safe. I can't penetrate that unless we have to fight. All right. So I'm gonna get to the dollar, and there's an ETF called DRIP, which oil drip. This company called Direction. That's how you say this, Direction. That's how you pronounce it. And they have a sense of humor. Okay, DRIP is a bear ETF, triple leverage. So I'm trying to say this properly. Theoretically, it rises when oil falls. Theoretically. This connects with that Exxon chart. And I jumped around from a metal, which is gold, to energy, which is oil. But from the perspective of the dollar, it's all the same. It's all the same. And that's why I'm dollar, because I trade the macro with the actions of the U.S. dollar in mind. That's not what I want. I want Exxon. Put this in back in your mind. We'll get back to the dollar. This, when I said that the Exxon rose to this area of interest, it seems like it wants to go down, and I'm saying it's trying to go below here, but well, we don't know that yet. Okay, it could catch itself. It could fall here, and these lows could hold, and then it could rise, and the whole downtrend could be over. I could be wrong. It's too early to tell. But in the short term, this is my working thesis from longer chart study, going back decades. But this thing has to go down. And I'm going to get to the dollar in a minute to show you why I think this. Okay. But back to drip. In technical analysis, we watch what people do and not what they say. Because people lie. Okay? But the way people spend their money, that's real. All that stuff on the news is propaganda. And I worked in the news business for over 25 years. Major 3-letter alphabet. But I got to hide behind this emoji because, I'm a little radical and I can have more freedom by staying behind this emoji. All right? So that's what that's about. And I hear y'all talking about, show your face, show your face. I'm like, dude, do something in life. Do something for real in life. That's the only people that's talking and show your face, show your face. People ain't never done shit. You don't have no real, you don't have no powerful enemies, okay? You don't have enemies with suits and law firms and stuff. You don't have that. So do something for real. And you ain't gonna be talking and show your face, show your face. Y'all know you're talking to emojis. You better start listening to people make sense and start worrying about what they look like. Anyway, you got volume. This is volume graph right here. Volume is transactions, orders. It's counting how many orders. It can be buys or sell. It doesn't matter. It's just orders. And so over time, you see. So this drip is a bearish ETF for oil. So as oil, in theory, as it goes up, this thing goes down. And so this high was in March of 2020 when we saw that rise. March of 2020, the rise in Exxon killed, it just destroyed drip. Drip was $594. Oil took off, it destroyed the thing, brought drip down to $9. So this is real. You gotta be right with these calls, especially if you're gonna be trading these risky things like this. Your chart game gotta be wicked. All right. But what we see on this volume bar is the number of trades increase. So as this thing started falling, and if we see the candle being red, we can assume that most of these sells. Most of these orders were sell orders. Okay. But just to get to the skinny, when we get to the current area, this candlestick here, not a candlestick, this bar, this volume bar here is for the month of August. We are looking at a monthly chart. This bar is for the month of August. August is 1 week old. There has been the biggest bar you see on this page. And I'm going to go all the way back. This thing can take us back to 2016. The biggest bar you see on this page is the week-old bar of August. So the transactions orders for the 1 week of August is greater than any month going back 5 years. Okay, that's real money. And the bar, and so we see it's green, and we'll see down here that this candle is green. So these are buys. On balance, these are buys. So Mostly these are buys. So we've had the greatest amount of interest or transactions and or greatest amount of desire to short oil in this last week, because this is 1 week of August, than at any month in the past 5 years. Okay, so let that sink in. So this is straight up technical analysis, looking at what people do. Now, why are they selling? We don't know. Why are they selling Exxon and buying this ETF which shorts Exxon? Why are they doing that? Well, did I say ask? Did I say ask? Ask someone in fundamental analysis, because they care why. On the technical side, we don't know why and we don't care. We only know that they're shorting it. And there's a lot of them doing it. Okay? That's enough for us. We buy and sell because they buying and selling. We don't never think we're going to be smart enough to know why. And to know why at the right time in order to do the right thing. Because we're not, what's that word? I don't have it. What's the word? We're not myopic. Okay? We're not myopic. So let me get on to the dollar to show how this weakness and I meant to show this. We're talking about that on the earnings. This thing came out on a week ago today, talking about the great profits of Exxon, and the fundamental mindset would say it's time to buy. Okay, whereas the technical mindset says, damn that, look at this overhead resistance. The people that got out of this, or the people that got trapped in this when the floor fell out, and now they got a chance to get their money back mostly, they're going to take that opportunity to get their money back. And so we saw the price make a lower low. Let's see what this, it definitely went lower than this. So that's significant in the technical, okay? Because uptrends make higher lows. And when we see something make a lower low, then that says, well, the sentiment, the opinion, the popularity of this thing is in question, because the market didn't come in and buy it on the dip and make it go higher, or stop it from making a lower low. No, it failed. So let me see. I don't know if it went lower than this one. Let me just check. 54.30. 54. No, it didn't. But it did go lower than this. And this is 54.59. I think this is just it's going to roll over. Let me go down to the daily. I think it is going to go lower. Yeah, I think it is. Even if we get another push up to here or something, it ain't. I don't think it's going above this. It's still going to roll over. Okay. What was that? Where was that? Oh, I'm making my way to the dollar. So when we go to the dollar chart, we should start to see something that looks like strength. Remember the old chart I showed, the rise since 1971. Well, let me I showed that. You can't really see it, but this is a decline since 1971. We're going to come from all the way in. So the dollar hit a low. So people tell you the dollar is just weak. It's just going in the trash and it's not worth anything. Sure it is. Yes, it typically falls. But the low for the dollar was in 2009. So from 2009, the dollar's been going sideways to up. It has not made a lower low. So anybody is talking about weak dollar since 2009 never looked at a price chart or don't know how to read one. Okay, so this thing is real. Okay, and you got people out here with degrees They don't understand how to read the price chart. All right. So you got the dollar looking like it wants to rebound right here. And so you got a break of this trend line when it was falling, so it started to rise. So you got a low, you got a higher low, it started to rise, and it came down again, but it made a higher low again. So in uptrends, prices, rise, go higher. And so you get higher highs and higher lows. Okay, so you had this little high here, the dollar came and took that out. And when it fell, well, we didn't know. Well, I had my opinion that this was going to hold, but I didn't know for sure that this was going to hold. But from my multi-decade study of price action and all of that, this is what I thought would happen. But it turned out to be so. So the price has some price action right here and right here. So when we got to these areas, people that missed out on this pop said, if it comes down here again, if I get another crack at it, I'm going to buy. And that's what they did. Okay. And so then these people said, man, I missed out. If it comes down to here again, I'm going to buy. So it came down in this area again here, and that's what seems to be going on. Okay. That's what looks like it's happening. And so, in short, my personal view is that the dollar is headed way up here. So we're talking about taking out the high from 2016. So that means the low for gold around 2016 is in danger of the price going below that. Because I'm saying that the dollar is going to go above that. So that would mean gold and oil would go below those places. So especially, let me just say, especially gold. But with oil, let's just deal with the March 20th. Where is March 20th, 2020? Okay, where is March? This is it. So when that big seismic shift happened, it sent the S&P higher. It sent gold up and oil up. This is what happened to the dollar. Okay, so the big question is, if the dollar goes above this point, then that's going to cause Exxon on the Exxon chart to give back. And this is March 23rd of year 2020. So if I am right that we're going to go and take this out, that would mean Exxon will go below the March year 2020 low. And that this channel, this price channel we see, these boundaries will be respected. It seems to be respecting this boundary here, and we're going to fall in the neighborhood of this boundary. It's got to extend out, taking us below this level, right? Because the correction in oil is something that, in order to understand it, you have to be looking on a chart going back, 100 years, 80 years. You have to be looking at the price action of major commodities from the Great Depression, into the Great Depression in 1931 or 2 or 3, somewhere in there. You have to be looking at that. You have to, no technical analysis. You have to study the price movement from then to these levels to understand the degree, the proportion of correction that we're in. Back to the word of myopic and the nearsightedness Myopic meaning short-sighted and nearsighted. If you think that what Trump did or what Biden is doing, if you only think in those terms and you don't think multi-generationally, and you look at the consumption and exploitation of raw materials over multiple generations, because that's the way countries think and do business and sign trade agreements. They don't sign these trade agreements last generations. Okay, so we're talking about a scale of correction to a level of prosperity, which caused the United States to become a world power. So it's on that grand scale. And so it's bigger than the nearsightedness that we are encouraged to have by the news cycle, which keeps us focused on Democrat, Republican, Trump versus Biden. I can't stand that crap. And you don't hear me in those discussions anywhere. It doesn't matter, okay? Whoever the president, their job is to manage the situation that they inherit. They can't change this flow. They can't change, they can't break off those trade agreements. They can't unwind this price escalation created by a multi-generational demand cycle. They individual, that you can't do that in 4-year increments. You know, we have a correction that we got to go through, and there's nothing nobody can do about it. You know, so what you can do is you can learn, and you can stay out of it. That's one option. You can just get out. 2, you can learn, get in an environment where you're discussing these things and looking at charts, which is what I do on my Patreon. We go in deep. And it's not just me, it's other people now that they've matured to a level where I see them more as peers now than students. So we got healthy debate and we have price levels which determine which argument is right. You have to get up off that argument if the price doesn't, if the stock or whatever the symbol is we're looking at, if it's not getting no love at these particular levels, which cause the price to keep making the higher highs and higher lows, which is indicative of an uptrend, or lower highs and lower lows, which is indicative of a downtrend. You can't be arguing one thing theoretically when the price, the market sentiment, as reflected by price action, is telling you something else. So this is like some brutal truth, you know, because truth is what's going on, not these theories people have in their head. So that's kind of what I wanted to show. And I'm sorry if I rambled a bit. And let me just stop and tell what's up. Wagner, Devon, Dewan Trade. Wow, I need to see you doing some more charts. I understand. I know how it is. And I'm telling you that. And I ain't done a chart in 2 months because we ain't getting that kind of love on these streets, man. I mean, we got this real game to give folks that can change their life, and we watching y'all, man, throw up super chats, $100 on people, and we struggling to get subscribers, man. I mean, it's rough, and so it's just so disheartening. And so my response has been to focus on my Patreon tribe and just give them my all. Because YouTube and social media break your heart, man. It'll break your heart, you know. I don't even have 1,000 subscribers. The number embarrasses the hell out of me. I turn this shit off because I don't even want to see it. Not only do I not want you to see it, I don't even want to see it. But it brings me down. I just turn it off, so I don't even know what it is. I just have to check it. I think I'm like 800 or something like that. But yeah, so yeah, Dewan Trades is a good trader. Y'all should go check him out. And you know, he'll go a little bit more into the fundamentals, but I respect the brother because he's got the technicals. I'm okay with fundamentals if you marry it with the technicals, and it's good information from that brother. You know? And like I said, what's up, Wagner? Iori, what's up? What's up? Iori is in the tribe. He's getting his technical game on. He's had some gains to be proud of. I mean, I have to shout him out. The brother blessed me with a nice little tip. You know, let's just say in the neighborhood of $1,000. So, although it just shows you how things come back to, I'm doing good, and my Patreon is only trying to do good for people. My Patreon is only like $10. So imagine how I feel when I see people throwing up $100 super chats and coming back the next day throwing up 50. I'm like, dude, that could have been a whole year of you learning on my page, man. So yeah, I get what am I trying to say? My commitment is fortified because I'm a capitalist, and that brother gave me that tip, man, about $1,000. I'm like, whoa, unsolicited. I'm like, whoa, and then actually before that, Maddie Ghost tipped me about $1,000. I'm like, whoa. And so it's like I can't lead them brothers. So no matter, I have to separate how I'm feeling about this YouTube experience from the Patreon experience. I'm all in. I'm all in with my tribe of Patreon. I'm all in with them. Sean Carter, another good trader. He's got a good understanding of the fundamentals. He knows them with the technicals, and you can get some good gains from this brother. Please go and sign up to Sean Carter's site and Dewan Trades, okay? Because we ain't getting no love. We ain't getting that subscriber love on these YouTube streets, okay? I always say, anyone who's looking for their freedom paper, they write in these charts. That's right. That's right. This is it. This is engaging with capitalism. Ground zero. Ground zero. Right in these charts. This is how you get free. The matrix is real. I'm all about fourth wave industrial revolution and all that. I'm all for that. If you want to get your degree, fine. But I'm telling you, you are still some degree of a slave if you don't understand how capitalism works. If you're not trading, you don't really understand how it works. You really don't. Because with this knowledge, we're told that you have to, in order for you to get rich, you have to have a job that with a huge salary. That's great if you can get it. I'm not discouraging that. But dude, with this knowledge, you can have a $50,000 a year job. It'll take you longer because your capital that you're working with is small. But these trends, you can 10x something in 5 years. That's not a stretch. You can 10x something in 2 years. There's people that 10x stuff since the low in March of 2020. So if you got 10 grand because you working a $50,000 a year job, you managed to have 10 grand and you got this knowledge, and you saved the money, and while you were saving, you were getting the knowledge. You're hanging out with me or somebody else, and you seeing in real time these theories play out, and you're acquiring the skill. And so you 10x that 10 grand to 100,000, and you 10x it again to $1 million. Now that might be 5 years, it might be 10 years, but that's definitely doable. But you need the knowledge. You're not gonna get it without the knowledge. Because I'm gonna tell you, in my 20s, this is while I was learning this stuff. I'm almost embarrassed to tell you, I had $250,000 several times, and I wasn't even 30 years old. But I didn't. I was in the fundamental camp, and so I would catch those. I caught a lot of .com stocks. I bought a mutual fund that focused on semiconductors, and that thing took off during the 90s. But because I didn't know technical analysis, I didn't know how to I didn't know concepts like sector rotation. from a technical analysis perspective. I was in these mature sectors that were, quote, overbought, as we say. That just means that a lot of money invested in it and the price has appreciated to an extreme amount, irrational exuberance, okay? I didn't know that um, I had that fundamental mindset that as long as the earnings reports are good, the price would just keep rising higher. And I thought like that. And then I got destroyed. I gave most of it back. Not all of it, but most of it I gave back. And then if I had known to look for greener pastures, look for beaten down sectors or industries, and look for signs of life, look for signs of new money coming in, establishing a price floor, and all these technical concepts, I could have protected that gain that I made um, in semiconductors and anything with internet on it was rising. Even if it didn't make any money, it was rising. But by the same token, companies that made money, they tanked too. So that's a lie that they tell you in the fundamental side that if you're in a safe company, a good, strong company with good earnings, you're going to be safe. No, you're not. No, you're not. You are absolutely going to lose your money. When it's time for that money to rotate to another sector or another industry, you are going to lose that money. And you're going to keep playing that cycle as long as your brain thinks the way it does. The truth is going to be coming at you, but you're not going to hear a lot of people saying it. And you're going to have to make a choice. You want to step out on what you see to be true, or you want to stay with that herd that just keeps going slow. It took me a while to go through those cycles of keep making a mistake over and over and over and over. Until I said to myself, coming out of that .com implosion, I was into James Cramer. His books are really, really good. If you want to learn fundamental analysis, I highly recommend his books. But you got to add technical analysis to it. Back then, he was against technical analysis. But when he had his rant around that period, he had his rant on TV saying, they know nothing, he was still principally a fundamental only trader. And so he got pimp slapped by his mindset and the reality of the technicals. And so there's been a conversion, and he's got a new religion now. He adds technical analysis. And I think it's every Tuesday, there's a segment called From the Charts or Off the Charts or something like that. So he respects technical analysis now. But he had to, he was personally losing money when he had that rant. Okay? So his fundamental analysis wasn't working. So he needed a new religion. And he found it. He and I and many others had to find, it's not the answers that you're looking for in life, it's the questions. It's the questions. And so I had to find the question. And the question was, who made money when the market went down? And what did they know? Or what's their ideology? It took me a while to learn the question. The answer took weeks. The question took years. Okay, so days to weeks to get the answer. Once you get the question, you're a few Google searches away from the answer. So I started finding the answers of who made money, and I started seeing what their belief system, what their trading methodology, and I started seeing things like the term technical analysis. I didn't know what that was. Okay, so I came upon that term and start looking at other terms under the umbrella of technical analysis. And that one thing led to another, got me to fall in, because you have to get used to technical analysis. You have to get used to being ahead of what most people think. You're out there on a limb with this belief, and you might look around on YouTube and find 2, 3, 4 other people who think like you. And so you lock in with them. And so you realize at some point, oh, you're actually with the leadership group. You're not with the 80, you part of the 20. And so it takes a while to get used to being in that small little crowd that really got their hand on how stuff really works, got their finger on it. And then you see everybody else turn around and catch up to you. You know, it's like everybody talking inflation, inflation, inflation. No. What are we saying in that small circle of the 20, of the 80-20? What are we saying? We're saying it's really deflation. Your concern is deflation. It's not inflation. It's your concern is interest rates rising. Interest rates rising gonna kill that housing market. When the dollar rises, interest rates that kind of go together. With the dollar rise, interest rate rise. The metals and oil, metals and energy. Let me say that. The reason why it changes from oil to energy, but that includes natural gas, coal, solar, wind, anything energy. They all pretty much trade together, which is opposite the dollar. Okay? Opposite the interest rate, pretty much too. So that's that. Let me see, I'm about to sign off of here. Let's see, Dewan or Sean, are you still there? Either one of y'all, click one if you're there. And if you want to hop on, I want to chat with you brothers just to see how your trading life goes. If either is still here. Going once, going twice, going 3 times. I guess they checked out. I've talked everybody into the room and talked everybody out. I'll do that. So I'm out of here. Peace, fam. Oh, I should be coming back maybe tomorrow, maybe today. Bitcoin. Peace.